Hi everybody. Thank you for tuning into our webinar titled Getting Reporting. My name is Allison Owen and I am the Client Relationship Manager with Pacific Stock Transfer Company. This webinar is presented by EdgarForFree.com and Pacific Stock Transfer. And as a special promotion to those tuned in to today's webinar, Edgar for Free is offering free OTC markets disclosure and news service subscriptions for qualifying companies. You can visit EdgarForFree.com today for more information and to learn how much Edgar for Free can save your company. We are joined today by Scott Klein of Lukuski Brookman LLP, and once I hand the floor over to Mr. Klein, you'll be able to submit questions that you have throughout the presentation via the question drop box on your webinar toolbar. And questions can be submitted anytime through the presentation, and we'll answer them at the end of the session in a quick question and answer session. If you have any questions that aren't answered or that come up after the presentation, please feel free to reach out to Mr. Klein or myself, and we will make sure that those get answered. With that, Scott, I will hand the floor over to you.
Thank you very much, Allison. Let me give you a little quick introduction about who I am. My name is Scott Klein, as Allison said. I'm a partner at Lukuski Brookman LLP. We are a boutique corporate securities firm based in Los Angeles and in New Jersey, New York, New Jersey. We are a small firm of 3 partners, 4 or 5 associates. All of us have X of the large firms, me of Pillsbury and Blank Rome, who have come together and are representing primarily small and mid-cap companies in the public companies primarily, or private companies in the going public process. So today we're going to talk about getting reporting. And first, let's talk about what that means. I'm not sure if the audience today are already reporting companies or private companies seeking to become public, in investigating what the reporting is. But my comments today will really be addressed to the latter. Companies and persons who are with companies that are not yet reporting. So reporting generally means reporting to the SEC, the Securities and Exchange Commission. That's what most lawyers and auditors think of as reporting. There's also a separate level of reporting separate type of reporting directly to the pink sheets that we'll talk about today. But let's talk first about reporting to the SEC. And reporting to the SEC means that a company, for a number of reasons, will be required to either voluntarily submit to or be required to file with the SEC quarterly reports, which include unaudited but reviewed financial statements, an annual report, which includes audited financial statements, together with a description of the company, management, and a whole litany of other things, such as recent sales of unregistered sales of securities, related party transactions, things like that. Companies are also required to make periodic reports of events that are out of the ordinary course of business, and sometimes in the ordinary course of business, like entering into a material contract, hiring a new auditor, firing your old auditor, departures and appointments of directors, things like that would get a periodic report. I.e., you don't wait until, in other words, you don't wait until the 10Q, the next Q or K. You would file an 8K immediately. And depending on what that reporting event is, you would get 2 to 4 days typically to make that filing. There are also reports due by officers and directors called Section 16 filings, Forms 3, 4, and 5, Section 13D, D and G schedules. These are reports of shareholdings, purchases and sales, and current shareholdings of officers, directors, and material shareholders, 5 or 10% shareholders, although it's not quite that simple, but generally 5 or 10% shareholders, depending on which one of those forms we're talking about. So those are the basic types of reports, and of course proxy statements for doing for things that require shareholder vote, and annual meetings to re-up your auditors and your board of directors. Those are the types of reports we're talking about. Now, the question is, which companies have to report? There's a number of ways that companies become subject to the reporting requirements of the SEC, of the Securities and Exchange Act. The first is something everyone's heard of, an IPO. That means a previously private company, i.e. company not reporting, not publicly held, not reporting, that does a public offering, an offering of shares to the public, whether underwritten or not, through an S-1 registration statement, typically, for a U.S. domestic company. But the act of filing that registration statement and selling those shares will subject you to the subject that company to the reporting obligations of the Exchange Act. Excuse me. In other words, the Congress, when adopting the acts, and the SEC has taken takes the position that if you are going to avail yourself of the money from the public to raise capital, you then have an obligation to provide information to the public through filings with the SEC. Another way to become subject to the SEC's reporting rubric is one that's has become increasingly popular, or became much more popular in recent years, and that's voluntary subjecting yourself voluntarily to the reporting requirements by filing what's called a Form 10 registration statement. A Form 10 registration statement will register under the Exchange Act a class of securities, your common stock, your preferred, whatever you choose to register. That form of registration statement was typically done by shell companies or by operating companies that chose to avail themselves of the public market, would like to avail themselves of the public capital markets. And I just answered really the next question that would be posed, is that it was, why would you voluntarily subject yourself to all those reporting requirements? Well, the investment community, whether we're talking about day traders or large underwriters or investors through large underwriters funds, virtually all investment streams need information in order to make those investments. Filings with the SEC is one of the primary ways that information is made available to the public. Recall that we're filing quarterly unaudited but reviewed financial statements and annual audited financial statements, as well as very specific information about the company, its officers and directors, its business, its an MD&A management discussion and analysis of results of operations, shareholdings of management. Some very detailed information is included in the annual report and certain proxy statements. So voluntarily filing a Form 10 and voluntarily submitting yourself to the reporting requirements is a way that companies, through a shell or otherwise, through merger with a shell or otherwise, would be able to attract PIPE investment or private equity investment that was wanted to be assured of a later exit. Now, PIPE investment is just an investment into unregistered securities that will get later registered. Instead of, compare that to an IPO where you're buying immediately registered shares, or a secondary offering, or a number of other direct public offerings. So And as I mentioned, that became increasingly popular over the last 10 years or so through the APO, or alternative public offering, or reverse merger process, which I'm sure everyone's heard a lot about. That 10 to 15 years ago, reverse mergers had a bad name. In recent years, they have achieved a level of legitimacy that I must admit that the number of many of the Chinese reverse mergers have chipped away at that legitimacy due to some issues with reporting that have been evident with those transactions. But nevertheless, in the absence of a small or mid-sized IPO market, which really hasn't existed since I first started practicing law 20-some years ago, the APO or reverse merger space will, in that investment vehicle, will continue in one form or another, I believe. The third way to become reporting, or to be required to be reporting, is to have a certain once you have a certain level of assets and a certain number of shareholders, then you are required to report to the SEC, and that's a $10 million asset level. And now, it used to be 400 shareholders, now 2,000. Although that lesser number, you can't have more than lesser number 400 of unaccredited investors. It remains to be seen how the SEC will test and determine the number of total versus unaccredited shareholders. The total number is easy to find, but how do you determine later, down the road, how many unaccredited investors or shareholders that you have? With that in mind, companies should really keep very good records. We should always, of course, keep very good records, but very good records of who your investors are. For now, for a number, not just for proving the securities exemption for that offering, but it now has relevance for yet another potential requirement down the road. So there we have the three primary ways that you would become reporting or end up either volunteer to be reporting with the SEC or be required to report with the SEC. Again, the reason why this reporting exists is to provide the market with the information that is on an exchange, on the bulletin board, on the major exchanges. And really, it does supplement private investment of unregistered securities by companies that are reporting with the SEC. The next level of the next type of reporting is reporting with or directly to one of the over-the-counter exchanges, over-the-counter systems like the Pink Sheets, of course, is the biggest. Here, you're not necessarily reporting with the SEC, and not necessarily reporting all of the information that you would report with the SEC. As we recall that we talked about, if you attended one of the prior webinars, we talked about the different categories of companies, including the public companies, including the different Pink Sheet categories. On the Pink Sheets, and I invite you to go onto just Google and go onto the Pink Sheets website, and very easy website to get around and go through the three levels of Pink Sheet companies. Companies that provide current information, companies that provide limited information, or companies that provide no information. So that's what we're talking about today, is reporting with the Pink Sheets as a current filer of information, or a limited filer of information, and of course the third category of filing no information will is self-explanatory. We'll leave that one alone today. So, of course, you have to when you are filing with the SEC. That's of course required by the major exchanges, NASDAQ, Amex, New York Stock Exchange. For many smaller companies, most smaller companies, we're not worried yet about the reporting requirements of the additional reporting requirements of those exchanges. And there are additional reporting requirements. There are additional rules about shareholder votes. There are many different requirements of those exchanges that apply once you can achieve that listing. But today we're going to focus a little bit more on smaller companies who will go into either the pinks or onto the bulletin board, the OTC QB or OTC BB markets. And as I said, most companies who are onto companies who are on the bulletin board really got there by one of two ways. They either filed an S1 registration statement, or they filed a Form 10, or they merged with a company that did one of those two things. One of the differences between those two things is that a company that's filing a Form 10 or a merger with a company that's already filed a Form 10 means you can generally raise other money, PIPE or private equity or other money, while you're doing the Form 10 registration statement. And a Form 10 registration statement is automatically effective, or it's effective 60 days after you filing it, which means the SEC can comment on it, but you're still reporting and you're still filing. You still start filing your Ks and your Qs. Compare that to filing an S1 registration statement to register a certain number rather than class of shares. You're registering a transaction, a particular sale of shares. That's the only, so there's some very strict rules in an IPO about doing concurrent public and private offerings. Just generally, there are some exceptions, but generally you can't do it. So you have that one offering, and you're not raising any money until that's effective, which can be a very long, multi-month process. Also, you're not beginning to report with the SEC, file your Ks and your Qs until it's effective. Okay, let's talk a little bit about what you need to do, what you're going to be filing. You need a PCAOB audit for that filing. I'm sorry, I had a little phone problem there for just a second. You need a PCAOB audit or an audit by a PCAOB licensed auditor, and you need for smaller companies you'll need 2 years, and if there's an interim period, a stub period. Now you will have to be careful for a number of reasons in picking out your auditor and choosing your auditor. Cost, excuse me, the cost of the auditor, how responsive they are, how available they are to your calls, how many people they have on staff in order to dive into your audit and get it done. All of those things are important. Another very important position is typically for smaller companies is an outsourced financial reporting consultant. They can really help you keep your audit costs down, which means and your legal costs down by getting fewer SEC comments. And I will tell you that most comments that we get from the SEC on 10Ks, on proxy statements, on S1 registration statements, are not related to the description of the business. They're not related to all the things the lawyer writes. They're related to the numbers. So it's very important that the first filing set the right tone with the SEC. Otherwise, you end up with several hundred comments, most of them accounting comments, and the accounting reviewers at the SEC are much more difficult to deal with than the other reviewers. So you also need a qualified securities attorney to prepare your registration statement, whether that's an S1 or a Form 10. It really should be an attorney that's done a bunch of these. It's not something you want to you want to pick a small, cheap firm to do that's really doing it the first couple. You want lawyers who have been doing this for a long time. Dealing with SEC comments is really an art as a science. The SEC, as an aside, the SEC really doesn't have the direct authority to say yes or no to an offering. Unlike some other jurisdictions which can determine, where the government can determine whether or not it wants the particular company to be public or do an offering, that's not the overriding purpose and rule in the U.S. Here, the SEC is really, what the SEC is concerned about is making sure that the information delivered to the market is full, complete, and correct and true. Not judging on the quality of the offering or whether people should or should not invest in it. But with that said, if the SEC doesn't like your offering, you can be in an endless loop of comments until you give up. You can be on. I've seen transactions with 8, 9, 10 rounds of SEC comments. The next piece of the puzzle are filings with FINRA. And this gets overlooked a lot, but after S1, after a reverse merger, the next step is to make an application to FINRA to get your symbol changed. You have to have approval to do a number of corporate actions like changing the name of the company, things like that, necessary for the bulletin board. Not the other OTC markets, but dealing with FINRA can be quite difficult, and they will comment on filings. In past years, this was a very simple part of the process. It is not so much anymore. So that is so remember that when you're dealing with your professionals about pricing the transaction. Does dealing with FINRA, is dealing with FINRA included in the price that you're quoted by both your auditor and your primarily your legal. You also need, through the process of getting reporting, a good EDGAR agent. What EDGAR is the electronic filing system that the SEC uses. Okay, electronic data gathering and retrieval system, EDGAR. It is just that, and just a different form of electronic presentation of the information, and now there is an additional presentation software form for the financial information that allows easier access to the financial information called XBRL, which takes a little while, takes several days to convert your financial statements into that XBRL form, and also is an additional fee. So you have to make sure you have a good EDGAR agent who does the XBRL conversions, and that they are both giving you a good price and they're qualified. Offline, I'm happy to make recommendations for that process, as well as for auditors. We have there's an auditor who works with us, who's been part of this webinar series called L. Bradford & Co. And you can get their information from Allison offline as well. But I can give you referrals to PCAOB auditors who have a lot of experience with making SEC filings and dealing with the SEC. So those are really the professionals that are involved in getting you reporting. Whether it's through, and of course, if what we're talking about is an S1 registration statement, you're also going to be dealing with your underwriter. But in a reverse merger scenario, where you are merging with a reporting shell, your primary steps will be getting the audit of the operating company and making the appropriate filings, the Super 8K filings, and the dealings with FINRA to take the combined make sure that the combined company is now fully reporting with the SEC and on the bulletin board, or in some cases on one of the major exchanges. The next level, if you're not quite ready for that, for audited financial statements, for being fully reporting with the SEC, but you still would like to access the public markets, would like to have information, public information available about the company because there are interested investors. That could also help you with dealing with suppliers and customers. You can become listed on the Pink Sheet. Now, the OTC Pink Sheet has, as I said, 3 tiers. The first tier for companies filing current information. On the slide deck today, I've just blocked and transferred directly from the Pink Sheet website some of the initial qualifications for the Pink Sheet current tier. You have to provide annual financial statements, the balance sheet, income statements, cash flow statement, the notes of the financial statements for the 2 prior fiscal years. Now, as opposed to the filings with the SEC, for which require those to be audited, you can become reporting with the Pinks, on the Pinks, with unaudited numbers. Now, if the numbers are audited, you attach the audit letter, but of course, but they do not have to be audited. You require that. So, in addition to that annual financial statement, you will provide quarterly financial statements, and there are a number of disclosure guidelines in the OTC for being on the Pink Sheets that you should separately take a look at if this is one of the things you're looking at. The financial reports have to be prepared, don't have to be audited, but they do have to be prepared in accordance with U.S. GAAP to be filed there. Now, if the financial reports are not audited, then you have to submit a signed an attorney letter agreement, which gives the public some level of comfort that the financial statements went through some level of diligence to be in being prepared and presented. Those are the requirements to get initially to initially file your information in the Pinks. Thereafter, you'll file each quarter within 45 days after the quarter ends, in accordance with those disclosure guidelines of the Pink Sheet, your quarterly financial statements, balance sheet, income statement, cash flow statements, and the notes. Again, according to GAAP, but not required to be audited. And then for each fiscal year, at the end of each fiscal year, within 90 days thereafter, after the end, the annual financial statement, balance sheet, income statement, cash flows, notes, and either the audit letter or the attorney letter. Okay. I've included in the slide deck those timelines that I just talked about. Those are we're using as an example the most recent dates. Now I understand that if you don't have that fiscal year end, you'll have to adjust if you don't have a 12/31 fiscal year end. But this is just by way of example. I'm happy to talk with anyone offline about other times. The second layer of the Pink Sheet filings is the limited information tier. This is the tier that shows the yield sign next to your company when you pull it up next to the company in your ticker. In this, you're providing, all you have to do is provide quarterly or annual reports for a period ending within the previous 6 months. You file it, you throw it up, you put it on in a PDF format, upload it onto the Pink Sheet website, include balance sheet, income statement, and just the total number of shares outstanding. Prepare in accordance with GAAP, but you don't need the cash flow statement and some other things. So a little bit lower standard, lower burden there. But because of that, you get the Pink Sheet's word of warning to people looking at this information, their yield sign. And of course, the third level is that there are companies that are included on the Pinks for one reason or another that are providing no information, and they get a big old stop sign by their name, which sometimes is not heeded by investors. So. One final note before I turn this over to see if we have any questions is that is one of timing and choosing where you're going to be reporting. How do you choose? How would a company choose whether you go into the pinks, the bulletin board, the major exchanges? What do you do? And the answer is somewhat like what we advise our kids who go off to go to college. You go to the best college you can get into. If you can generate the interest from investment banks to do an IPO, to do a public offering, to get on the pink, to go directly to one of the major exchanges, then and your company is growing and can use that money, then there's no reason. Then that is probably what you will do. That's probably what you should do. But we realize that the market realizes, the law realizes, investment community realizes that not every company can do that. So the bulletin board is a nice middle ground. It is not exactly a training ground for moving up to the major exchanges, but because many companies stay in the bulletin board for many years and do quite well there. But it does serve for a lot, serve the purpose for a lot of companies to be a training ground to prove to the market that you can meet your earnings expectations, that you can take money in from investors and put it to useful purposes, that you can report accurately and timely, and those efforts and grow your business in the way that you say you will, and those efforts get rewarded by higher stock prices, higher trading prices and volumes, which allow you to then go uplist. But even the bulletin board, is a little is too burdensome for many small companies that still need access to capital, and the pink sheets is the answer there. On one of the three levels, let's just talk only about let's stay only with the current filing level of the pink sheets. Companies that can come up with, do your financial statements on a quarterly and annual basis under U.S. GAAP, report that information, maintain reasonable internal controls, timely report, that will be rewarded on the pinks. There are many companies on the pinks that trade very well, that show increases in their stock price and liquidity, then price and volume, and there are ways for those companies to then uplist to either the bulletin board or to a major exchange. Normally to the bulletin board first, and then hopefully to an exchange later. The primary, as I mentioned before, the primary issue in uplisting to the bulletin board from a pink sheet company is getting those audits done, which requires getting the right auditor, getting the right outsourced audit financial consultant, reporting consultant, the right law firm. We work, McCuskey Brookman work with a number of banks who are investors who are interested in helping companies uplist. We work specifically with a group in New York that has a very effective program of investing, making an investment into pink sheet companies that are well traded and well positioned to move up, to help pay the fees to uplist, and we've seen that be quite successful. So there is an advantage for companies to becoming reporting on the pink sheets. Now, I do want to mention that there are risks involved with reporting your information to the public. That risk is primarily that if you report whatever you say to the public, when you begin to report information to the public, that information has to be true. The information, not only does the information you report have to be true, but you cannot fail to include information that's necessary to interpret that information. So you can't give half of the story. You can't give part of the story. Okay. So there are some obligations that come with reporting. that are a little beyond the scope of this short webinar, but I'm happy to answer those questions offline. Like anything in life and the law, it is always a yin and yang, a balancing act as to advantages and disadvantages. The advantages of reporting making your public information, making your financial and other information public, doing press releases, having a place to put those releases, having some information out there when you report, when you issue a press release that people can look at it and then go see other backup information about the company is valuable both for public investment, private investment, for your suppliers and customers to know that they're dealing, what kind of company they're dealing with. That is of course a very valuable process. If you're a private company right now, speak with an attorney who's familiar with this process to help you design a plan to make your information public, to make you a more attractive target for investment, either through the PINKs, the bulletin board, or some other, or maybe one of the larger exchanges if you're ready for that. So with that, Allison, let's open the floor for a few questions.
Sure, thanks, Scott. So again, you can go ahead and submit your questions in that little question drop-down box in your webinar toolbar if you have any questions. We do have a few already, Scott, so I'll go ahead and get started with those. Can you comment on the quiet period when filing both 10K and S1 for a PINK?
Well, yeah, there's a specific quiet period after filing an S1 registration statement. Now, this is a very detailed process that's really way beyond the scope of this. I'm happy to my telephone number and email address is in the last page of my slide deck. If you shoot me an email, I'm happy to talk about this with links with anyone who has specific questions about this. In general, let me answer in general though. When filing an S1 registration statement for an offering, what the SEC wants to know is that filers are not using this registration statement to do other offerings, right? Because the notion is that you're going to tell the public, assert the information that the SEC tells you, prescribes for you to tell them, and only that information. And you're only going to give the public the, excuse me, the prospectus that goes with the S1 the registration statement. So because of that, what follows with that requirement is that you're not going to go off and have side offerings and side deals, okay? That was pulled back in a little bit in past years with some no action letters from the SEC about concurrent public and private offerings, and that's gone through some changes and some back and forth. I'm happy to talk to you about that as well. But in general, once you file you have to begin to be careful of the information that you're disclosing to the public 30 days before you file the registration statement. And in between the period of the registration statement is filed and when it's declared effective, there's only limited information. That's a quiet period. There's limited information that you can give the public. You can't go out and do other offerings. You can't go do mailings and get in magazines, give interviews. There have been some very famous cases of CEOs giving interviews during that quiet period. Not saying much about the offering, but giving interviews. There's some exceptions of what you can do. If you typically give press releases, you can continue to do the same sort of press releases. I.e., not give away any information by let the market know something's happening by failing to give, by all of a sudden stopping. But it is very limited information. All you're allowed to give the public is the prospectus. In particular, specifically, what you would go out and give to investors is the preliminary prospectus or the red herring, because it's got red warning language along the spine. and then you follow that up with the final prospectus after its pricing. It's very detailed and long process. Happy to talk to you about it, but in general, 30 days before, watch out, and after the filing, very limited information. In and around the 10K or the Qs or the Ks, there are also windows of filing information windows, and not so much a quiet period per se as that term is really used in the S1, the IPO process, or the registered offering process. But those quiet periods, if you will, relate to the fact that officers and directors and others may have inside information. They have inside information by definition that the market has not been made public because the K has not yet been filed. So most public companies will have a plan internally in which there are blackout periods or open periods during which, just to be sure, officers, directors cannot sell shares. And those blackout periods, there are blackout periods during the couple of weeks before a K or Q, and they open back up after for a short period after the Q. Now, there are ways for officers and directors to buy shares periodically according to a plan, a plan that you set up previously and then don't touch, where you buy a certain amount or sell a certain amount every excuse me, each month. But generally, the blackout period, around Ks and Qs relate to the non-public information that these insiders will have. That rule exists throughout the year, and there are some very specific rules related to that. There's the short swing profit rule that I'm sure people have heard about. Officers and directors of a public company cannot do a buy and sell transaction within 6 months. And there's a very active plaintiff bar that looks at, keeps track of your Form 3s and Form 4 filings to make sure that purchases and sales of officers, directors, insiders has not occurred within that 6-month period, because then they can go sue the company, have those profits, sue that insider, have the profits disgorged back to the company, and then of course they get their legal fee. So that, in general, those are the reasons for, and in general, the general timelines of blackout periods. I know that that's probably not as specific as you wanted, but we could talk for a couple of hours on just that topic. So shoot me an email, give me a call, and I'll talk to you offline.
Okay, we've got another question. Does a registration statement on Forms S1 make you a reporting company automatically, or do you need to file anything else with the SEC?
On an S1 registration statement, yeah. Well, there are a couple. There are some filings that you do have to make with the SEC under the Exchange Act that go along with the S1, but you're required to do them. So effectively, yes, you are. Doing an S1 effectively means that you are becoming a reporting company. There are some additional filings that your lawyer will handle. There are a number of filings in an IPO. If you, I can send me an email and I'll show you a list, a time and responsibility list for an IPO, and it is 50 items long of things that get filed in and around the time of the effective date or close date of an IPO. Okay?
Okay, and we've got a .com company is formed, has business and profits, but is less than 2 years old. How can it be listed?
Well, you can, the requirement for the financial statement can be shortened if you don't have those available times, right? So there are many examples of companies that have gone public that are younger than that. Okay, so that is an exception. Really, it's there's a 2-year look back for smaller companies, a 3-year look back for larger companies. But there are many examples of IPOs by younger companies. So you can look back to it. You can look back on a shorter period of time if the company was not in existence. So that's typically not a problem.
Okay, awesome. I think we are out of time, but thank you everybody for tuning in. If you had questions that weren't able to be answered today, please feel free to reach out to myself or Mr. Klein. Mr. Klein's contact information is up on the screen, and you all should have been receiving your tune-in information from my email, but just as a reminder, it's aowen@pacificstocktransfer.com. Thank you, Scott, for tuning in, and thank you so much to everybody else that tuned in to Getting Reporting by Pacific Stock Transfer and Edgar for Free. Scott touched on how important Edgar filings can be, and so check out edgarforfree.com if you have any other questions or want any more information on quality Edgar filings. Thanks again, and have a great afternoon.